huh?
That is nice. It does look nice. All right, guys, welcome to the Infinite Wealth live stream. Here we are once again, third Thursday of every month. We are here answering your questions on anything and everything IBC. And so, Anthony, again, what are we going to be talking about today?
Well, we've had a few questions that people have submitted. If you have some questions while we're here, throw them in the chat. That's what this is for. Questions about infinite banking or passive income. Cameron and I can help you with any help you need with hair products. Cameron will be here to help share his wisdom.
Lucky you. Lucky
and then
you.
we're also share maybe some things that are going on, maybe some updates of anything that for you to expect coming up.
Absolutely.
And you know what, on that, before we get to the questions, one thing that we're going to talk, it's getting close to the end of the year and insurance companies are declaring their dividends.
A little teaser, huh?
Right. So by next month, all of them will have declared the dividends. So we're taking a little time to kind of say who is where are the dividends are going. I will say what I've seen early on that they are staying the same, but that's just a couple companies. But we're dive more into that next month.
Little teaser. Well done, Anthony. All right, awesome. Let's see, what do we got here?
Oh,
Dustin, just diving right into IBC information. But first, let's get to Dustin's question. It says, where does Cameron get his shirts from? Well, this is a medium first and foremost, so kind of in there between a small and a medium. But these are actually Travis Matthew shirts. I don't know if you can see the logo there, but I used to be in the golf industry for a number of years, and I hated all the golf shirts. They were terrible fitting. And then Travis Matthews came along and updated them quite a bit. So, Dustin, I hope that helps you, man. I don't know if that was a serious question or not.
Well, Dustin, I was expecting him to ask a hair question or maybe where we get our passive income shirts.
Yeah.
That's what we should have worn today. But all right.
I don't know. I think Dustin's happy.
Okay. Thank you, Dustin. Yes, we do. I like to think we do. Now, another question we got here. This one was submitted.
That's a good one.
I just set up a living trust. Does that affect my policies?
Anthony, let's go. Yeah.
Big fan of living trusts.
Okay.
Right. And the reason being, and the trusts are it's a very vague or broad term. There's a lot of different types of trusts. What I think almost everyone should have is a living trust. What that living trust, the sole purpose is to avoid probate. Now, probate is when you die, the assets in your name, the government it'll go through a court proceedings to determine where those assets should go, and people have the ability to stake a claim to those assets. Those going through that process is very expensive. Now, way around that is we have the assets in a living trust that does not provide asset protection. What it does provide protection from is going through probate, because those assets are owned by the trust. So when you die, the ownership really hasn't changed, right? So big fan of a living trust. Now, when you get those, what we'd recommend that you change the beneficiaries of all of those to the trust. And the reason being is we want to protect that death benefit from probate. I mean, again, we're talking morbid and really worst case scenario, right? But let's say my wife and I are in a car accident and I pass away at the scene. Okay. Then my wife, this is deep, but I'd rather pick myself than somebody else. But
yeah,
I know I should have killed you off, but I like Jess too much. But
surprised you didn't. Yeah.
But then my wife passes away a few days later. So if my wife is a beneficiary, those assets, that death benefit goes to her the day after I pass away. And then when she passes away, they're in her name. So they're going to go through probate. So change the beneficiaries to the trust. And what I do recommend is if you own trust on somebody else besides your spouse.
Policies.
Yeah. For example, I have a spouse, I have a policy on my kids, on Becky, and on Cameron, and I have some other policies on third parties. Those I want the owner to be the trust. Because let's say, for example, I have a kids policy, which is probably what most of our clients have when a third party. If I were to die, if that policy is one of my assets, if it's not in the trust, it's going to go through probate. So we can easily solve that by just having the ownership, changing the owner to be to be the trust. To do that, very simple. It's a one-page form, and we can gladly help you with. So, thank you for submitting that question.
I'll add a little extra there. Yeah,
we got some good questions.
I know. That's why I laughed. I don't know if you saw that one. Thanks, sir. And also is in along those same lines is we've got a lot of those questions on estate planning, right? This, once we get a policy set up, the second or kind of natural conversation is, hey, who should own it? Who should be the beneficiary? We get those questions a lot. And so next Q&A, we haven't confirmed the dates, but we are going to have our very own estate planning attorney come in, and he's going to give us some updates on irrevocable, revocable, and certainly he's going to have some insight on living trust and ownership, in addition to our resident expert here, Anthony Faso. Yeah.
Wow, you give me a compliment.
I know.
Which is, I want to absorb this moment for a second. Okay, but if you have those questions for the attorney and you can't make it,
send them in.
I just put in the info@infinitewealthcourse.com, or you can DM us through Instagram or Facebook or whatever. So
we got a good one right along the lines. Jacob, I'm surprised you opened with this without making fun of me, but right there, click on that one. Throw it up there. Does that add any complications with policy loans? Anthony, we're changing ownership. We'll touch on beneficiaries. Beneficiaries won't change anything at all. But what about ownership? You change ownership to a trust. Does that complicate policy loans?
Great question. No, it shouldn't. And I'm going to get a little technical, but a living trust, is considered a disregarded entity, which just means that entity is kind of see-through, and whoever owns that entity is really the true owner, which means there's no tax consequences for this. And I will tell one area where it can complicate it is if you get a check for a policy loan, that the check will be made out to the trust. So that means you need to have a bank account for the trust. But that brings up another good point, Jacob, is that the first thing that you should do when you getting the trust is step one. That's what I know. I talk a lot about knowledge isn't power, it's action, right? And so having the trust is a knowledge, but unless you put it into action, it's just a piece of paper. So to put it into action, we need to put assets in it. So we could put your policies. I have my house in the trust, and I also have my bank account in the trust. So that way, when my wife and I die, the trustee will be able to have access to my bank account, and we're dive deeper into that when we have when we have the attorney on.
Yeah, well said.
Okay, so where are we at here?
Right there. Let's jump to Sarah. Let's get that one out of
there. I kind of okay.
You want to save that?
Yeah. Okay. Well, let's just. I mean, it's a good question. I mean, so you want to read it?
Yeah. These Fasos just taking shots whenever they can. Sarah, thank you. She says, "Do you have a promo code for Paul Mitchell?" I'm sure she's probably piggybacking on Dustin poking fun of me as well, but no, it's a good point. I do need to get a promo code. I should get some sort of affiliate link for Paul Mitchell products. Maybe we'll get after that.
Yeah. We need to add that. Yeah,
absolutely. Let's do it. So if you know anybody out there in IBC world, let me know.
Okay. Next question.
Ooh, I just bought 3 ATM machines. Should I use my HELOC or a policy loan to pay it? Good question.
Great.
Good question.
So what? And I just met with a client this week, and that was a question that they had asked. So I know a little bit more of the details, but the first thing that we want to look at, well, first, did you know that you could have a business owning ATM machines? What
I
I'm
did.
doing is I'm just plugging our podcast, right? But
So you
what I'm
asking
going to
me?
do is I'm going to put in this link here, a link to, we actually did a podcast discussing how you can create a business owning ATM machines.
Yeah.
Okay. So the first thing we're going to, when we look at these transactions, there's really two things we look, or two lenses we look through. One is, I say, more of the spreadsheet, more, like the numbers. And then the other lens is the real life, or some of the intangibles. And if we look at it, for when we're paying this, one of the first things we'd look at is interest rates, or the cost of money, right? Which one is going to be lower? So if we're looking at just the spreadsheet, who has the lower cost of funds, right? And what I'd also look at is which one is tax deductible. In this situation, they both are, right? As long as we use, as long, let me take a step back. Some of the rules change in the deductibility of a HELOC, right? And before, you can just take that loan, and people are buying credit cards, paying off debt, and then they were deducting that interest, similar to mortgage interest. But the government put a stop to that, and you could only deduct the interest if you use it to improve the home. Okay. But that's looking through deducting as mortgage interest. But if you have a loan for your business, or really a loan to generate taxable income, that loan interest you use can be tax deductible. So in this situation, they both are, right? But we also want to look at some of the intangibles, right? And some of those are going to be, if I put this on the HELOC, that's going to be reported on my credit. So maybe if you're looking to finance or purchase a home in the near future, you having that on there may not, may hurt you from buying that house. Okay. Also, the repayment schedule, like a HELOC, you got to pay that every quarter. Sorry, every month. And if you don't, again, you're going to get a ding on the credit. If we put this, if we're using a policy loan, a no payment is required. We do highly recommend you make repayments, but sometimes we can't. So we have some of those flexibles and or intangibles. But one thing, and I think we're going to talk more about this coming soon, is a HELOC can be frozen, right? So as we're getting deeper into this recession, personally, I'm going to start drawing down my HELOC because I'm afraid it's going to get frozen, right? And that's what happened to me in 2008 when the housing market went down. The bank froze my line of credit. So I don't want that to happen, because when things are dire like that, that means a lot of banks are not lending, which means having liquidity is going to be crucial. So I want to have access to that liquidity. So what I will do is take that HELOC and some other lines of credit, and I'm going to access it now. But then where should I put it?
Are you asking?
Yeah.
In a policy.
Yeah. So
policies, multiple.
Yeah. So that's one reason why I always have some policy loans outstanding. So I have a place to put that money where it's going to be liquid and protected.
Great question. We've got one here with Jacob. I'm asking this because we just went through it and I didn't realize when we set it up. In what ways are you able to get loans with a PDF as collateral? Just went through this. I'm not sure exactly what Jacob is referring to as he just went through this, but with a PDF, getting loans as collateral is what you're going to do is I don't know if somebody's listening, they don't know what a PDF is. Let me give you a little backstory or update. PDF is short for Premium Deposit Fund. And what you do is you can put money into that Premium Deposit Fund, and then the insurance company will use the funds in that account to pay premiums over a specified number of years. Anywhere from 2 to 10, typically we're doing 7. So really what you're doing is you're funding a premium deposit fund here, and the policy starts at 0, and then over that specified number of years, the cash just changes. So what you're able to do, the opportunity that you have is you can take your policy, your cash value, and you can take the funds in the premium deposit account, and you can reach out to a third party, a bank, and you can assign those as collateral. And so when you assign those, they're going to extend you a line of credit that's equal to the balance of the cash value, the end of your balance in that premium deposit fund. So that's what you do to kind of set up that with the premium deposit fund as collateral. And what ways are you able to get loans with the premium deposit fund? The way that you're able to get a loan is you take it to that third party. And there's just a few kind of banks that will lend against a premium deposit fund. So, I don't know if I missed something there, but exactly what he's asking is how do we assign it? That's how you assign it.
Yeah. And Jacob, if you have some more detailed questions, reach out to me and we can gladly go further.
Yeah. Don't reach out to me. I don't want to save the hair jokes. Just kidding, Jacob. All right. What do we got? LELOC only.
Mm-hmm.
So Jacob adds LELOC only, not policy loans from insurance company.
I think that's what you were discussing in regards to borrowing from a third party.
Yeah.
Now, we've been.
I don't know. I don't know if I'm missing the question there.
I think it's part of the one of him getting loans with the PDF, and I do think you surprisingly did address it. But that LELOC can be a great strategy to access the equity in your policies. As these interest rates are rising, the interest rate in the LELOC is getting higher. So we will be discussing more of that with the rising interest rates and changing dividends next month.
We could give a teaser too on PDFs.
Go for it.
I'm not going to give it now. I'll just say that next month we'll have an update on some PDF changes for you guys that
they're only getting better.
I think you'll like. Yeah. So stick around. That looks.
I thought there was. Oh, this one.
Yeah. Fire away, man.
Okay, here.
Yeah. Oh, there it is. I missed it. All right. We got a lot of comments. Thanks, guys. Appreciate you throwing those in there. Most of them are just digs at me. So appreciate those comments. Thick-skinned. It's up a little bit more. There we go. This was a conversation. This is a question that we just had earlier yesterday. This is asking, is there any end of year planning that I need to do for your policy?
That's a great question.
It is a good question. That's what I thought.
Good job, Becky.
Yeah, well done, Becky. End of year planning. When I sat and you kind of think about what the policy is, what first comes to mind is I would take an inventory of your policies. And what I would tell you is that the policies that we issue are not based upon calendar year. I think everybody that has one knows that, but they're based upon policy anniversary. If you go in there and you look at it, right now is a good time to do some accounting, pull out the policy, take a look. And the biggest thing that you're going to want to make sure that you look at that comes to my mind is the PUAs. Mm-hmm. PUAs are very flexible. I would look back at my policies and look to see if I have max funded my PUAs on all of my policies to make sure that I didn't miss anything. And additionally, I would look back at the previous year's PUAs to make sure that I didn't miss anything. most of the policies that we issue are going to have at least 1 year of catch-up provision. So number one, PUAs kind of come to mind. Taking inventory and then making sure you probably plan out those premiums and when they're going to be due for the previous year. But that kind of what comes to mind. Anthony, anything you got there?
You want to explain the catch-up provision?
Catch-up provision is that PUA is very flexible. PUA is the paid-up addition rider. That's just cash. So in a policy, you got the base premium, and typically what clients are doing is they're going to pay that out of pocket on a monthly basis. And then annually or certain points throughout the year, we'll dump in and pay that PUA. So that's how sometimes we might miss a payment here and there, whether it's just sitting in our checking account or whether maybe it didn't line up with the time that we needed or time we had in our account. So always look back on the PUA. I forget, what was your question?
What was the catch-up provision?
Oh, the catch-up provision, yeah. The PUA. So if you go and you pay your PUAs, it's an optional payment. So let's say that you can put into $10,000 into your PUA on any given year, but for whatever reason, you skip 1 year and you don't pay anything. The catch-up provision allows you to pay the last year's of the previous year's PUA that you skipped. So you can pay last year's and you can pay the current year's PUA. So great option that's available to most of our clients on the policies that are in place, and a great way to make sure that we kind of max fund these policies.
I'd like to add a thing or two, if you don't mind.
Oh, I knew you would. Go for it.
You know, I think for one that this question is coming, I don't know, but I'm assuming like a tax perspective.
Yeah.
Right. We think there's some tax year-end planning that we need to do. Your policy is outside the tax system. So your premiums and the activity in there are not affecting your tax return. So typically there isn't a calendar year importance, right? But what I would say, though, that hopefully you are paying the interest, right? But one thing, and I think the only thing that might affect taxes would be if you hadn't paid the interest that year, which is nice that we have that ability to. But if we use that policy loan to create taxable income, that interest is tax deductible if we pay it. So this might be a time, well, hey, if you need some deductions, and you didn't pay the interest, maybe you go ahead and pay that interest before the end of the year. Then that's really, to me, the crucial thing to do before the end of the year. But I would also add to what Cameron had talked about and taking the inventory. Have you moved? Right? Maybe there's a change of address. Did you get married? Did you set up a trust? Is there any kind of lifestyle changes that happen that might affect the policy? That might be a good time for us to make any changes.
Awesome. Well said.
Okay. So those are the questions that
those are questions we have for this week.
Yeah.
If you guys have any others, throw them in the chat box, and we're happy to field them here in the last couple minutes. Other than that, we've got our podcast. It's going to go out every Tuesday, so guys, be ready to listen and subscribe to those as well. And then we're going to have our live stream podcast, live Q&A again next month, and we're going to have a special guest, estate planning attorney, to dive deep into some of this irrevocable, revocable, and some of the family trust information or questions that we've gotten so far. So we will see you guys next month. And I would say, Jacob, we appreciate you coming around and making some comments. Next time, if you could write in full sentences, that would help me understand what you're trying to say. So appreciate it. All right. Take care, guys.
On that note, go make it a fantastic day.